Howdy, Jacob here. Today we're looking at eBay and the broadline retail industry, 31 billion market cap, a billion greater enterprise value. They operate marketplace platforms that connects buyers and sellers. So I feel like this was like the first almost Facebook marketplace, but then you don't actually have to see them. You just send a product and get paid for a product. Uh, I remember this when I was super young. So, I mean, it was pretty popular for a while, but their revenue growth is not very substantial. I think competition in the retail industry, of course, on even online e-commerce has just been absolutely wild. So I guess it doesn't surprise me that revenue growth is 1 to 3%, with a gross profit that's gone down, operating margin gone down. They do pay a dividend. It's 1.68% yield. It does look to be a reasonable amount of their earnings. We'll see on the free cash flow side. Good return on invested capital. We'll see if they actually utilize that or not. So income statement does show 1.5 billion in R&D still. Really? Okay. I mean, they have 15% of their revenue spent in research and development, taking money away from today to hopefully make more in the future, more efficient, more growth. That's peculiar. Good for them. Their balance sheet has a lot of cash on hand, 7 billion in short-term investments, 2 billion in cash and equivalents, with 7 billion long-term debt, 750 million short-term debts. They have more cash-like products than long-term short-term debt. So we're feeling fine about that. Cash flow statement shows, a good amount of cash flow. Their cash flow's gone down a lot, which kind of sucks, but they've also probably made more devastations than acquisitions in the last, or uninvested rather than reinvested over the last 7 years or so. But their other use of cash is just share repurchases, dividends. So they are still technically reinvesting, but they're also making a lot of devastation. So I think they are trying to become more efficient, which is good because their margins have gone down. And the majority of their money is just going to share repurchases and dividends. So to me, even though it has a higher return on invested capital, they're not actually reinvesting to get those historical massive rates of return. So to me, that destroys the premium and that necessity. On the revenue growth side, let's get to projections here. So revenue growth side, a lot of competition, but I do think there's some reinvestment and acquisition opportunity to get 4%. I think market average seems to be reasonable to me, with a, what does 20% look like? I guess it's been a bit higher. So let's do 25, 22. Share change, massive share repurchases, $300 million. So $600 million plus $1.2 billion is 2%. I think I'm comfortable with that. And the dividend, I don't really want to increase that too much. It's already paying out, I guess a third is pretty reasonable, but not a lot of history. Let's say they grow it with their revenue, so it stays at roughly a third with these similar margins. So 29% drop before you get the return we're looking for here. Not terrible. I do think that I'd probably want a greater return, even though they're buying back so many shares. To me, I think there's a lot of competition in this industry, and I think that I don't necessarily know. I would say eBay has a moat. I think a lot of people know about eBay, but I don't know how many people are utilizing an eBay over just your classic Amazon. Clearly a lot of people are, because they have a crap ton of revenue, 10 billion in revenue. So a lot of people are using it. I just don't know those people. So for me personally, I would probably require a little margin of safety, maybe a little bit more conservative on the growth and margin side, since if you have increased competition, you're likely going to have to dampen price a little bit. But for right now, it still doesn't need to fall too much more before you get the return looking for you. So this could be an interesting business. Hope you enjoy the video.